Good morning, guys. Welcome to Finance Widget. And today we're going to talk about Yes Bank. It was at the center of one of the worst banking crises in India's history. The founder was arrested, depositors couldn't access their money, 81 bondholders were completely wiped out, and tens of thousands of retail investors lost significant portions of their wealth. I own it, and I want to show you exactly why. Not the headline version, not the optimistic version, the complete picture, the collapse, the rescue, the numbers today, the risk that still exists. And despite all of it, I believe the market is significantly underpricing where this bank is heading. Now, now before I get into the analysis, I want to be upfront about something. I'm not here to sell you the stock. I have a position in Yes Bank, which means that I have skin in the game, and you should factor that into how you receive it. This what what I will do is show you my complete research, the bull case and the risks, and let you draw your own conclusions. That's how I think serious investing should be discussed. This chart tells you everything about the fear. Why What it doesn't tell you is what changed inside the institution since that bottom. And that's why that's what the next 30 minutes are about. Let's start with what Yes Bank actually is today, because I'd argue most people are still pricing the old bank, not the new one. So let's start with the chart because I before I spend 30 minutes walking you through the fundamentals of this bank, I want to show you what the price action is telling us and why I think the technical picture is genuinely interesting. So, from a long term perspective, Yes Bank remains in deep drawdown territory. The lifetime high was 406 and the current price is around 20. That's a decline of 95%, and I want to be clear of what that means technically. The stock at this stage of drawdown don't recover in a straight line. They require time, sustained fundamental improvements, and a shift in the market sentiment. Before any durable uptrend can emerge, sentiment alone is sentiment alone is never enough. Price confirmation is everything. So the question I ask before anything else is the chart giving me early signals that if something is changing? And right now I think it is. What I'm seeing what I'm seeing on the long term time frame is a formation of a cup with handle pattern. Now for those who don't know what a cup with handle pattern is, a cup with handle pattern is a technical formation where a stock goes around it, undergoes a rounded decline and recovery, forming a shape of a cup like this. I'll just draw it for you like this, followed by a shallow consolidation phase called the handle before a potential breakout. So this is the handle right now, and we are here. It is generally considered a bullish continuation and or a reversal structure, particularly after extended period of consolidation like we've seen here. The neckline of this pattern is around 32. A decisive breakout above 32 is supported by strong volumes would be technically significant. It would indicate a meaningful market sentiment, not just a bounce, but a beginning of a structurally different phase of the stock. based on the parent's measured t- measured target. A sustainable breakout um, a sustainable breakout projects a move towards 53, around 55. That's a big that's that's the big picture target, but there's also an earlier development worth noting. This stock has already broken out of a short term the stock has already broken out of a short term downtrend, uh, right here. um, yeah, an earlier trend line that had been capping price action for an extended period. This breakout has already occurred, and it proved a nearer term technical target around 34 here, right here. The stock If the stock price can sustain above this level, it becomes an intermediate conversation confirmation, a stepping stone towards the testing of a larger cup with handle neckline at 32. Here's why I think about here's why I think about the technicals this way before anything else. When I'm evaluating a turnaround stock, the chart tells me one thing that fundamentals cannot. What the market is actually doing with the information it has. Fundamentals tell me what should happen. The charts tell me what is happening. And in a turnaround, timing matters enormously. Buying a great story for 6 months too early is in the wrong price structure can be as painful as being in a entirely wrong three thesis. And trust me, I've been through this so many times, and it is the worst thing you can do to your portfolio. It tells me that you so so what does the chart tell me right now? It tells me that Yes Bank is transitioning from a prolonged downtrend into the base building phase. The selling struck the selling pressure is dominated the stock for years appears to be exhausting itself. Accumulation is happening slowly, quietly, without the market paying much attention. And in my experience, that's exactly when turnaround opportunities are the most interesting. The the 32 to 34 zone is a key inflection point. That is where the market will decide this a temporary rebound or a beginning of a more sustainable recovery cycle. I have my view. The fundamentals are all convinced me. Now let's get into those now. Okay, before I walk you through the collapse, I will walk you through it in full. I want to show you something that most analysis of the stock skip entirely. They start with the crisis. I want to start with where the bank stands today. Because here's the problem with leading with the history. It anchors your entire perception of to a version of this institution that no longer exists. And it and I think that anchoring is a large part of why the market continues to undervalue the stock. So let's reset. I want you to look at these two columns of these two columns, 6 years apart, structurally different institutions. Let me walk you through what Yes Bank actually is in 2026. It is a full private sector bank operating across retail, SME, and corporate segments. That part hasn't changed. What has changed fundamentally is the composition of the business and the quality of the balance sheet running underneath this. The most important structural shift is the loan book. Previously, Yes Bank's growth was driven heavily by large ticket corporate lendings, concentrated exposure to small number of borrowers, many of whom later defaulted. That concentration is what turned a liquidity problem into an existential crisis. Today, SME, retail, and um, other smaller segments contribute roughly 51% of the total revenue, up from around 41% earlier. Corporate exposure has been deliberately reduced. This matters because retail and SME lending is inherently more granular. Instead of instead of 10 large loans that could blow up simultaneously, you have you have thousands of smaller loans across different geographies, sectors, and risk profiles. The mathematic of of diversification works in your favor. No single no single default can move the needle on the balance sheet the way it could before. Now look at the asset quality. Gross NPAs as a percentage of the loan book stood nearly 14% during the crisis. Today, they sit at approximately 1.6%. Net NPAs are around 0.3%. This is not marginal improvement, this is a complete transformation of the risk profile of this bank. Deposits, n- this metric, um, this metric I watched, wait, yeah, this metric I watched closely in any turnaround banks because deposits cannot be manufactured through accounting. Customers either trust you with their money or they don't. During the crisis, deposits collapsed from around 2.27 lakhs to around nearly 1.5 lakhs. No, 1.05 lakhs, as you can see here. That collapse represented a real world vote of no confidence from depositors. They were pulling out their money and walking out of the door. Today, deposits have not just recovered, they have surpassed pre crisis levels, reaching approximately 3, 3 lakhs 18,000 crore, with a year on year growth of across approximately 18%. That recovery is a single most credible signal in this entire investments case. It tells you that ordinary customers, the people who interact with the bank every day, are coming back. On the operational side, the bank operates over 1,200 branches and more than 1,300 ATMs across 300 different districts. But more importantly, nearly 90% of the transactions are now conducted digitally. Yes Bank handles a significant share of UPI transactions in India. It has built platforms like Iris by Yes Bank that position it as a technology driven bank franchisee rather than a traditional lender. This is not a legacy institution changing clinging to old infrastructure. This is a bank that rebuilt its distribution, and digital capabilities simultaneously during the recovery phase, which is genuinely difficult to do. Capital adequacy, no, not this, sorry, that's for later. Yeah, adequacy, CRAR, sits at approximately 16%. That's a comfortable buffer that supports future loan growth without requiring emergency capital raises. The bank has the room to expand its balance sheets from a position of strength rather than a necessity. Now, here's where the farming I want you to carry into everything that follows. The management and the governance framework of Yes Bank failed catastrophically. That is an undeniable fact, and I will not minimize it. But the underlying franchisee did not fail. The branch network survived, the customer base survived, the digital infrastructure survived, the corporate relationship survived. The What the crisis destroyed was trust and the leadership, both of which can be rebuilt and both of which are actively being rebuilt. That distinction between franchisee survival and management failure is the intellectual foundation of my entire bull case. And the bank that had that had to build its franchisee from zero would take decades to reach where Yes Bank already is. This bank doesn't need to build it to prove consistently the quarter after quarter it that it can operate its existing franchisors, better leadership, and tighter discipline. This is a fundamentally different and far more achievable challenge, and this is the way I own it. Now, to understand why that franchisee survived and why the recovery is credible, you need to understand what exactly went wrong, not the headline version, the complete version. This is the question that determines everything, because it doesn't matter how good the current numbers look, how credible the new shareholders are, or how compelling the valuation appears. If the root causes of the collapse are still present in any form, the investment thesis collapse with them. So let's be precise about this. Not optimistic, not pessimistic, precise. I want to separate the structural flaws from the residual effects, because these are two different things, and confusing them leads to the wrong conclusion in either direction. Structural To build a credible bull case on any turnaround stock, do we have to do something most retail investors skip. We have to genuinely understand what went wrong, not the surface version, not the one line explanation, the complete picture. Because if you can't understand exactly what caused the collapse, you cannot assess whether those causes have actually been addressed, and the assessment is the entire basis of the investment thesis. So let's get go through it properly. So Yes Bank was founded in 2003 by Rana and Ashok Kapoor, which with a clear ambition to build a next generation private bank that could eventually compete with institutions like HDFC Bank and ICICI Bank. It it all and for a significant period that vision appeared to be materializing. Between 2005 and 2018, the bank delivered extraordinary growth. The loan book compounded at roughly 30 to 40% annually. The market capitalization crossed 90,000 crore. The stock market, the stock reached levels near 400. Return ratios were strong, analyst coverage was positive, institutions were present. From the outside, Yes Bank looked like one of the India's greatest financial success stories. The problem was what was happening underneath. Unlike more conservative private banks that built their books on granular retail lendings, Yes Bank had extended significant and concentrated exposures to some of India's most financially stressed corporate borrowers like DHFL, Reliance Communications, Jet Airways, ILNFS, SL Group, Cox and Kings, and CG Power. These were not peripheral exposures. They were large concentrated bets on borrowers that were already showing signs of financial stress. When when these companies began defaulting, not one by one, but in a cluster, the simultaneous deterioration in asset quality created a cascading impact on US banks' balance sheets. This was this is what concentration risk looks like in practice. It doesn't hurt you when markets are rising. It destroys you when they turn. The second structural flaw was systemic underreporting of net NPAs. This is where the situation moved from poor risk management into something more serious. RBI inspections revealed a significant divergence between what Yes Bank was reporting and what actually stressed on its books. In 2016, a divergence of over 4,000 crores. In 2017, above 6,000 crores, and in 2019, a divergence of 2,999 crore. This is what this means in plain language is that in loans the bank was classifying as performing as healthy were in reality already stressed and defaulting. The financial statements presented an artificially strong picture of asset quality, allowing the bank to sustain higher growth optics and a strong reported profitability, while the actual risk on the balance sheet was accumulating silently. This is not a technical accounting matter. This is a bank lying to its investors, its depositors, and the regulators about the health of its loan book. In the con- and the and it continued for years. The third structural flaw was governance failure and promoter misconduct. The most prominent case involved transaction links to DHFL. The bank invested heavily in debentures and extended additional loans to related entities. Investigations later suggested potential irregularities, including allegations of quid pro quo arrangements involving entities connected to the promoters' families. There were also concerns around inflated collateral valuations, where the security backing loans were overstated, masking the true risk profile of the assets being lent against. And then there was a promoter share pledging approximately of 80% of Rana Kapoor's holdings were pledged against the borrowers. As the stock began to decline, which it inevitably did once the NPA reality started surfacing, lenders invoked those privileges Pledges, lenders invoked those pledges, forced selling entered the market and accelerated the share price decline, which triggered more pledges, which triggered more selling. A textbook negative feedback loop. Each step down in price caused the next step down in price. By 2018, the situation was have had escalated to the point where Reserve Bank of India forced Rana Kapoor to step down as CEO. This was not a routine management transition, was a regulatory declaration of lost confidence in the institution's leadership. The market reaction was immediate and severe. The bank struggled to raise capital. Interbank trust weakened. The large depositors began moving funds to safer institutions, and once depositor confidence begins to crack in banking, it is extraordinarily difficult to stop. In March 2020, RBI imposed a moratorium on Yes Bank. Withdrawal limits were capped at 50,000 per account. New lending was restricted. The board was superseded. This was one of the most severe banking interventions in India's recent history, and it coincided almost exactly with the global market panic triggered by COVID 19, which meant the bank's crisis was unfolding against a backdrop of maximum market fear across every asset class simultaneously. Between 2018 and 2020, yes, bank's share price collapsed from 400 to nearly 10. One of the most controversial aspects of the rescue was a complete write-off of 1,815 crore worth of additional Tier 1 bonds. 81 bondholders were entirely wiped out. Equity shareholders were not. This reversed a conventional capital hierarchy. In normal resolutions, equity absorbs losses first and then bondholders. Here it was inverted. This decision triggered multiple legal disputes and created lasting damage to institutional trust in Indian banking instruments. In in its It is the part of Yes Bank's story that sophisticated investors remember, and it is a part of why institutional hesitation around the stock persists even today. Finally, Rana Kapoor was arrested by enforcement authorities on charges including money laundering, corruption, and misuse of public funds. Whatever ambiguity remained about the nature of what had happened inside Yes Bank was removed at this moment. Now I've spent time going through all of this deliberately, not for drama, not to sensationalize a well known story, but because understanding the collapse at this level of detail is what allows to make the because understanding the collapse at this level of details is what allows me to make the next argument with a genuine conviction. Every single one of those structural failures, the concentrated corporate lending, the NPA underreporting, the government misconduct, the promoter pledging, regulatory breakdowns, had a root cause. And the root cause was not bank's franchisee. It was not its branch network, its customer base, its digital infrastructure, or its deposit gathering capability. The root cause was the people running it and the culture they created. And those people are gone. The question now, which is the most important question in this entire analysis, is Whether removing those people and overhauling everything around them was enough, whether the institutions that exist today is genuinely structurally different, genuinely structurally different, or whether the problems were deeper than management, embedded in the culture, the systems, the DNA of the bank itself. That's what we're going to examine next. The first flaw was concerned concentrated corporate lending. That has been directly and materially addressed. The loan book has deliberately reoriented retail and SME, uh, now represents over 51% of the revenue versus 41% before. Corporate exposure has been reduced. The bank is no longer making large concentrated bets on individual borrowers. The lending uh, architecture is fundamentally different. The second flaw was NPA underreporting. The mechanism that enabled this opaque management, weak compliance, regulatory arbitrage under Rana Kapoor has been dismantled. New leadership tighter RBI oversight, and the presence of institutional shareholders like SMBC and Carlyle created multiple layers of accountability that did not exist before. Underreporting at the scale that occurred previously would require a coordinated failure across management, auditors, board, and regulators simultaneously. This is a structurally far likely today. The third flaw was governance misconduct at the promoter level. Rana Kapoor is gone. The promoter shareholding that created the pledging cascade has been eliminated, replaced by institutional shareholders with no personal borrowings against their stakes. The conflict of interest that sat at the heart of governance for failures that has been structurally removed. As you can see, there are no promoter holdings. There are around 46% of the stock is owned by foreign institutional investors, and only 31% of stock is owned by public. So, on the three primary structural causes: lending concentration, misreporting, and governance misconduct, the honest answer is yes, they have been materially addressed. But here is where I want to be careful, and this is the part most bull cases on yes bank skip. Addressing structural causes is necessary but not sufficient. What matters in banking more than any other industry is whether the market believes the structural causes have been addressed. Because banking runs on trust, and trust once destroyed at this scale does not return because management changed or a new shareholder arrived. It returns through one thing only: demonstrated behavior over time. And this is where the deposit chart becomes the most important piece of evidence in this entire analysis. At the depth of the crisis, the deposit collapsed to approximately 1.05 lakh crores. This was not a balance sheet number, this was behavioral signal. Ordinary people, businesses, and institutions were physically walking out into branches and moving their money elsewhere. That is the most direct expression of loss of trust in existing uh, that exists in banking. Now, look at what happened since. Deposits um, recovered to 1.62 lakh crores by 2021, climbing re- continued climbing, reached pre-crisis levels by 2023, and today it approximately stands at 3.18 lakh crores with 18% year-on-year growth. I want to be very clear about what this data represents. Deposit growth cannot be manufactured through accounting. It cannot be inflated through financial engineering. It cannot be driven by management narrative or investor relations. It is the result of millions of individuals' decision by ordinary customers and retail depositors, small businesses, corporates choosing to place their money with this institution. When deposit recover at this pace, it means something real is happening at the ground level. The trust is returning, not fully, but measurably and consistently and verifiably. This is the most credible data point in Yes Bank recovery story. Most credible than More credible than quarterly net profits, or more credible than any analyst target price, because it comes directly from the behavior of people who have the most to lose if they get it wrong. Now, and this is equally important. I'm not gonna tell you the turnaround is complete, because it isn't. The structural causes have been addressed. The depositor franchisee is recovering, but the residual effects of the crisis are still visible and still material. Profitability remains below normalized levels. Returning Return on equity is expected around 8 to 10%, significantly below 15 to 18% delivered by leading private sector bank peers. The share dilution from 2020 rescue has expanded the equity base substantially, which creates a ceiling on earnings per share growth even as absolute profits improve. And the trust deficit, while narrowing, has not been fully erased. Large depositors and corporate clients still carry the memory of March 2020. That memory fades slowly. The more accurate farming, the more accurate farming I can give you is this framing. The more accurate framing I can give you is this: the structural cracks that caused the collapse have been repaired, but the building is still under renovation. Yes, bank is no longer a distressed institution, but it has not yet transitioned into a consistently performing franchisee. It sits in a space between those two states, where the probability of survival is high, but the certainty of long-term outperformance is still contingent on execution. And that space is intermediate f- it, that and that space, that intermediate phase between stabilization and compounding, is exactly where the most interesting turnaround opportunities tend to live, because the by the time the compounding is obvious, the price already reflects it. Right now the price reflects the fear of the past more than the reality of the present, and the gap between those two things is where I believe the opportunity exists. But before I make the valuation argument, I want to show you the journey of capital that got this bank from a moratorium to where it stands today because of the journey, or because that journey is one of the most underappreciated parts of Yes Bank's story, and it tells you something very important about quality of conviction that serious institutional money has placed behind this recovery. The capital infusion journey in Yes Bank is not just a series of funding events. Yes Bank deal. It is a story told in three distinct acts. Each um, each tells you something different. Each tells you something different about where this institution stood at the moment and where it is was heading. I want you to walk through all three because when you understand the progression, the current situation looks very different from the. Wait a minute. MSN. Money control. Let's go to money control. The current situation looks very different from where it's heading. Act 1 Survival. In March 2020, RBI imposes a moratorium, withdrawal limits are capped, and the board is suspended. The institution is, for all practical purposes, on life support. What happens next is critical, and it is often misunderstood as simply as a government bailout. It was not simply a bailout. It was structured reconstruction. A consortium a consortium or led by SBI, India's largest public sector bank, infused capital and took an anchor stake of approximately 49%. Here, let me just show it to you. Yearly, oh, yearly, and then here, 49% here. Yeah, sorry. Alongside SBI, seven other investors participated like HDFC Bank, ICICI Bank, Axis, Kotak Mahindra, and investors like Rakesh Jujunwala, Radhakrishnan Domani, Azim Premji. Together, they infused 12,000 crore rupees into the institution. Now think about what the list of the name represents. These are not distressed debt funds looking for a quick trade. These are some of the India's most sophisticated capital allocators, institutions and individuals with deep knowledge of in the Indian banking system, impeccable reputations and no tolerance for reputational risk. Their participation was not charity. It was a calculated assessment that the underlying franchisee had survival value and that under proper governance it could be rebuilt. The assessment was the first institutional vote of confidence in Yes Bank's recovery. The mm, moratorium was lifted within days. Normal banking operations resumed, and reconstruction framework gave the breathing room it needed to begin a long progress of stabilization. Act 2 Stabilization. Once the interim, Once the immediate survival question was answered, the next phase required a different capital, a king of capital, kind of capital, one that signaled not just a rescue, but genuine recovery potential. The sign came from global private equity, the Carlyle Group, invested approximately 7,400 rupees, 7,400 crore rupees. Advent International invested around 1,500, together nearly 9,000 crore rupees of global private equity capital entered Yes Bank during the stabilization period. I I want to spend a moment on what it means because private equity capital in a distressed banking institution carries a specific information. PE firms do not make emotional investments. They do not invest in narratives. They invest after exhaust, exo exhaustive and due diligence, stress testing balance sheets, interviewing management, modeling recovery scenarios under multiple assumptions. When Carlyle and Advent committed capital of this scale to Yes Bank, they were effectively publishing their conclusion. The stressed asset cycle is sufficiently contained. The franchisee has recovered. The well recovery franchisee has recovery value, and the risk reward is attractive at these levels. This is a meaningful signal, not because PE firms are always right, they aren't, but because the rigor of their process filters out situations where the problem are deeper than they appear on surface. The presence of their presence meant the balance sheet was cleaner than the market feared. Regulatory ratios strengthened, incremental loan growth became possible, and most importantly, the narrative around Yes Bank began to shift from survival to potential recovery. Act 3, po- Growth Positioning. This is where the story changes qualitatively, not just quantitatively. In May 2025, SMBC, one of the Japan's largest and most globally respected banking institutions, announces an investment of 13,483 crore for approximately 20% of Yes Bank at 21.5 rupees per share. If I want you to sit with that number for a moment, 21.5 rupees per share. The the 2020 rescue investors entered at nearly 10 rupees per share. SM SMBC entered at and SMBC's entry price implies more than 2x return for those early rescue investors. In a stressed financial institution in the market that was deeply skeptical about the recovery in the capital market, entry price is a signal. When a globally respected institution with exhaustive due diligence capabilities chooses mark up a distressed asset by more than 2x, they are not doing it because the story sounds compelling. They are doing it because their analysis of the balance sheet and the franchisee, the competitive position, the regulatory environment, and the management team supports that valuation. The markup is institutional validation that the recovery is real, not narrative driven, real. The but the SMBC transaction is more than just a valuation signal. Look at what did it do to the ownership structure. State Bank of India, which had been the anchor institution during the rescue, with approximately 24%, reduced its holdings to around 10.6%. SMBC emerged as the largest shareholder at 24.9%. This transaction was structurally significant. It represents a shift from government led stabilization framework where SBI's presence was essentially a regulatory necessity to a globally backed strategic partnership, where SMBC's presence is a forward looking commercial decision. Those are fundamentally different ownership motivations and they carry fundamentally different implications for the bank's future direction. Now, does SMBC's present actually mean for what actually means for Yes Bank going forward? First, governance. Governance. SMBC's right to nominate board members introduces international oversight and global banking standards into an institution that had collapsed precisely because of a government governance failure. This is not a cosmetic improvement. Board level representation from a Japanese mega bank where the global regulatory relationship creates accountability structures and that simply does not exist under previous management. Second, strategic opportunity. SMBC is not a passive financial investor. For them, India represents one of the most structurally unpenetrated credit markets in the world. A young population, a growing middle class, rapidly expanding corporate activity, and still relatively low formal banking penetration. Yes Bank gives them immediate access to an established distribution network, a functioning banking platform, and existing corporate and retail relationship that would take decades to build from scratch. The relationship works both ways for Yes Bank. SMBC's presence open doors, access to a global capital and potentially lower costs correspond banking relationships across SMBC's international network, enterprise in trade finance, structured lending, and cross-border transactions that Yes Bank can now offer to its corporate clients. Third, and this is the point I think the market has most significantly underappreciated, the se- the sequential progression of capital into Yes Bank tells the story tells that the story is more important than the individual transaction. 2020 RBI and SBI ensure survival, distressed credit capital, distressed rescue capital. 2022 to 2023 Carlyle and Advent provide stabilization capital, sophisticated PE firms with full due diligence. 2025 SMBC provides strategic capital, a Japanese mega bank making a long term commercial bet on India through Yes Bank. Each tranche of capital is qualitatively superior to the last. Each investor did more due diligence than the previous one. Each entry price was higher than the previous one. The progression is not coincidental. It refle- coincidental. It reflects a bank that has genuinely improved, not just in narrative, but in substance. At each stage of the recovery, investors who looked hardest found more to like, not less. At this point of the analysis, having seen the structural transformation, the bank deposit recovery, and capital infusion progression, the question is no longer whether Yes Bank can survive. The question that question was answered in 2020. The question is now whether it can execute consistently enough to justify a full re-rating. From a recovery story a distressed multi trading at distressed multiples to a stable banking franchisee trading at the multiples its improving fundamentals deserve. To answer that question, we need to look back at the numbers, what the financial performance actually shows, and what the quarterly results are telling us right now. Let's get into it. Let's talk about numbers now, because at the because at some point after the history, after the ownership changes, after the strategic narrative, what determines whether a turnaround is real or just story is what the financial statements actually show. And I want to walk through this carefully, not just the headline numbers, but what's actually driving them, what's still incomplete, and what am I watching going forward. Because in a turnaround situation, understanding the direction and quality of the numbers matter more than the numbers themselves. The bank reported revenue of, of approximately um seven thou- of approximately 7,662 in the most recent quarter on an annual basis. Trajectory this has been going consistently upwards, as you can see here. The core business activity is scaling steadily. This is not this is not recovery stage revenue driven by one-off items or exceptional gains. It reflects normal banking operations functioning and growing, lending, fee income, treasury, and payment activities all contributing. The franchisee is working. What what stable growing tells you. Profitability. This is where the recovery becomes visible. Yes, bank reported net profits of 1,882 crores this quarter, with a um, with a growth of 45% year on year. Now, I want to be precise about what is driving growth, because the quality of the earning matters as much as the quantity. A significant portion of the profit improvement is coming from declining credit cost, lowering provision requirements as legacy NPAs have already been recognized and written off or resolved. This is not operational outperformance yet. It is normalization. The bank is no longer setting aside the large chunks of income to cover bad loans because of the bad loans because the bad loans have largely already been dealt with. This is important. This is an important distinction. It means current profitability is cleaner than historic profitability during the crisis, but it is not yet at the level of a fully optimized banking operation. The next stage of profit growth will need to come from genuine operational operating leverage, better margins, higher loan growth, improved fee income. That stage is ahead, not behind. Um, Gross NPAs are approximately 1.3, net NPAs are approximately 1.2. Compared to those where this bank was during a crisis, gross NPA approaching 14%, and S&P is in double digit too. The scale of improvement is difficult to overstate. This is an a marginal progress. This is not marginal progress. This is a complete transformation of risk profile of bad loans. And critically, the mechanism that drove this improvement is not just time. It is active resolution. Over 43,000 of stressed assets were transferred from JC Flowers ARC, one of the largest single stressed asset transfers in Indian banking history. The bank did not wait for bad loans to slowly recover. It moved aggressively to clean balance sheets and redirect management attention towards building a new book. That decisiveness is a meaningful sign about the quality of the post crisis management. One important nuance: the finances segment reported a loss of approximately 366 crores, with a negative margin of roughly minus 5% in the latest period. I want to address this directly because it is not the kind of numbers that looks concerning in isolation. In context, it reflects on ongoing balance sheet normalization. Banks in recovery phase deliberately prioritize asset quality correction and risk recalibration over short-term margin optimizations. They accept temporary segment level losses to ensure the overall book is clean and stable. The this is disciplined behavior, not a warning sign. I'm watching it, but I'm not alarmed by it at this stage. Deposits, we covered in this context of trust recovery, but back let me bring it back into the financial context. 18% year on year growth, um, deposit growth to approximately um, 3.18 lakh crores in banking deposits. Growth is not just a trust signal, it is a financial performance driver. A growth stable a growing stable deposit means base means cost of funds. Lowering cost of funds means better net interest margins. Better net interest margins means higher profitability. The deposit recovery is not just a sentiment story, it is an input that drives a financial improvement you're seeing in every other row of the spreadsheet. A flywheel is turning. The deposits growing, cost of funds improving, margin expanding, profitability increasing slowly but measurably. Return on equity. mm, yeah, where is return on equity, yeah. Return on equity, and current return on equity is approximately 7%, expected to stay in the range over the next few years under most analysis and analyst projections. Top tier private sector peers like HDFC, ICICI, and Kodak Bank operate in the range of 15 to 18 ROE. This gap is real, it is significant, and I'm not going to minimize it. In banking, valuations is directly and mechanically linked to ROE through price to book multiples. The bank generates 8% ROE deserves a lower price to book than the bank generating a 17% ROE because the return on capital deployed is materially low. This is not sentiment, this is mathematics, and it is the primary reason why Yes Bank continues to trade at a significant discount to established peer despite visible operational improvement. The reason behind the subdued ROE are structural and worth understanding clearly. Sorry. Higher cost of deposits relative to best in class peers because of liability franchisee while recovering has not yet reached, reached the efficiency of institutions with decades of uninterrupted but uninterrupted trust building. A more cautious post-crisis lending strategy, which compresses margins, but is the correct approach to the stage. A residual impact of heavy share dilution from the 2020 rescue, which expands the denominator in the ROE calculation even as the numerator improves. So, why do I own a bank with a 7% ROE when I can own ICICI Bank at 17%? Well, it's because I'm not buying what Yes Bank is today. I'm buying what it can become as this normalization continues. The same operating leverage that once drove aggressive and unlimited, ultimately unsustainable expansion. The branch network and digital infrastructure, corporate relationships, the payment franchisee is now being applied to a cleaner, better governed, more retail oriented book. As credit costs continue to normalize, the deposit franchisee becomes cheaper and more sustainable and more stable. As the retail and SME mix continues to shift, ROE will improve not to 17% next year, but directionally and measurably over the next 3 to 5 years. And here's a key insight about turnaround valuations most retail investors miss. The re-rating does not happen when ROE reaches 15%. It begins when it begins happening when the market becomes convinced that the ROE is going to reach 15%. That conviction momentum when the trajectory always or the when the trajectory becomes undeniable is typically when multiples expand massively and rapidly, and it is almost always happens before the destination is reached. The investors who waited for the full confirmation pay full price, and investors who buy the credible trajectory, if if they've done their work to distinguish a genuine trajectory from a false recovery, capture the re-rating. um CRAR is approximately 16%, comfortably above regulatory requirements. The bank has capital buffer that supports loan growth without emergency dilutions. This is important because one of the most structurally vulnerable during crisis was capital inadequacy, and the inability to absorb losses without internal external support. That vulnerability has been addressed. The plan to raise up to 16,000 crore rupees through a mix of equity and debt provides additional strategic flexibility going forward. The bank, the loan growth, digital investment, and the maintaining adequacy ratios as the best as the balance sheet expands. Taken together, this is what the financial picture tells me. The bank, the core banking engine is stabilizing, Asset quality risks are largely contained. Profitability is improving with clear driver, declining credit costs today, operating leverage tomorrow. The deposit the deposit franchisee is recovering in a way that directly feeds future margin improvements. Capital adequacy improve provides a to grow. What is what is not yet complete? ROE normalization, full trust rebuilding, operating margins optimizations. These are the these are the variables that remain. In turnaround situations, this kind of profile improving across most metrics with identifiable remaining work is often leading indicator of a deeper structural recovery rather than a lagging indicator of providing of problems persisting. The keyword going on forward is consistency. One more thing I want to address before I move on to valuation, and this is a new leadership. Because the financial recovery without stable, credible leadership at the top is fragile, and there has been a significant development here in April 2026 that I think the market is not clearly digested. Let me show you what I mean. In 2026, Vinay Tonse assumed the role as the managing director and CEO of Yes Bank. He comes from SBI, bringing with him decades of experience and credit culture, risk discipline, and institutional banking relationships. At India's largest bank, this matters for two reasons. First, continuity of institutional discipline. SBI's credit culture is conservative, process driven, and deeply focused on risk management. Importing that culture into Yes Bank's leadership at this stage of the recovery, when the bank needs to grow its book without repeating past mistakes, is exactly the right hire at this for this moment. The second, timing. Tons's appointment coincides with SMBC's consolidating its positions as the largest shareholder. New strategic anchor, new leadership, new chapter. These transitions don't happen in isolation. They reflect deliberate repositioning of the institution for its next phase. What I will be watching in his first 4 to 6 quarters guidance delivery in NIM improvements or any strategic pivots in lending mix, and how he manages cost to income ratios towards the guided low 50 ranges. Those will be early indicators of whether this leadership transition accelerates the recovery or introduces a new execution risk. All right, we have the technical setup, we have the business transformation, we have the history and whether it has been addressed, we have the capital journey, we have the financial performance. Now let's bring it all together. What it what the bank is actually worth, and I believe why the market is mispricing it. Okay, so let's move on to valuation now. So before I get into it, I just want to mention that I'm not going to use any conventional valuation methods like DCF or anything else. I'm gonna use some different valuation methods. So let's get into the. I'm gonna use one of my own valuation methods. So before we get into that, let's get into some other simpler methods like figuring out the PE ratio and all. So as we can see here, um, we go to max and then we see the PE. Yeah, so we see the PE is the average P is around 24, and right now it's 17. So the share price will have to rise approximately 24 divided by 17, 41%. So let's see if that's true. Um, so the share price would have to rise approximately 41%, which is around here 27.84 divided by 1.12. 27.84 divided by 1.12, which is 24.8. Yeah. So for the P method, the share price would have to rise around the level of 27.89 to meet that. So let's just mark the let's just mark that level 27. Let's just mark that level, and for us to the median P is 15, so actually this is like in the same range as the other banks. Let's go to the net profits. Let's go to sales. By sales, this bank is above these two. So then IndusInd is above IDBI, and Yes Bank is the sixth largest bank by sale, I think. And for Yes Bank to reach that by market cap, it has to increase its market cap by around 9,000 crore rupees more. So let's just check. Let's just check how much is that. Let's just copy this. Control V divided by divided by hmm, where is it? Copy. So that's 1.41, 1.14. So that's a 14% increase from this. So that's gonna be around here. 22.74. Let's just recheck it. 22.74 times the number of shares. It should, so if we times it by the number of share, it should give us 71,000 crores. So the number of shares are here 3138. 3138. So yeah, it gives us around that. So that's our that's one of our valuations too. Let's move it there. Then PB, since like we can calculate this too, PEG ratio, but I think the growth right now isn't that stable. It's like it's still gonna fluctuate, and like the growth is gonna, I think it's gonna grow around 20%. I think the median growth is around 20%, 24%. So right now using the PEG ratio is gonna be kind of really, it's not gonna be super accurate using the PEG ratio. We can check through this, but this is also normal. So yeah, we checked through this. We checked through PEE ratio and the comparison, the relative valuation ratio, the relative valuation method too, and we got valuations around this area. Now let's go to my own tool here. This is not a qualitative valuation tool actually. This is more like a full-on valuation tool. Sorry. Yeah. So right now, so you can read this here to understand what is happening. So here we need to just enter our here we need to enter our net profits and all of this, that it's asking for net profit, operating profit, sales, and total assets. I'm not going to add operating profits because as you can see it's in the negative, and I gave you the reasons for it, so we don't have to add operating profits into it. Now now here in Yes Bank, 5 years ago the net profit was in loss, and I of course like removed all the exceptional items and all. So I made this. So we just added this. We just 2x this and we added it here too. So for example, if this is at 34.89, I just added 34. I just added mm, 34.89 times 2. I just added this to both of the profits. So I just added this to both of the sides. So this one would be 34.89 and in the positive, and this one would be 3512 plus 3512 plus 34.89 times 2. That would give us this and this. So, and then I did the same thing for this. I inputted all of this. And then 5 years ago, I picked I picked um March 31st as my anchor price. So I picked April. Yeah, I picked April as my anchor price. So it's gonna be here. And I picked the current price other as my current price today. So from this, it ran all these calculations, uh, and it showed me basically whether the stock is undervalued or overvalued. And right now it shows me the fair value is from the net profit valuation. The fair value is around here. The sales and net profit is around 47.2. Sales is 23.67, and total asset valuation is around 26.98. But to make this more accurate, I'm gonna go down and I'm gonna fill in um, scores for these qualitative factors too. So my qualitative factors are management quality and track record, competitive moat, earnings quality and consistency, growth runaway, balance sheet strength, governance and capital allocation, and regulatory and macro risks. And according to their importance, I gave them their weightage. I can change these based on the business, but right now I'm gonna keep this as the basic ones. And out of 1 to 5, I gave them a score. So I gave management a 4 out of 5 because the management track record is honestly astonishing. But since the new management has come in, I there's a little bit of uncertainty, so I gave them a 4 out of 10. Competitive mode, the company has some differentiations, majorly through high interest rates and all, but there's nothing more than that usually. Earnings quality and consistency, I gave this a 4 too, because the earning is growing consistently, but it's not growing through the core business, it's growing through the provisions and all, to not having um, to not having to give more money to provisions and all. Okay. Growth runaway, I gave that a 3 because it has moderate growth left. I think Indian banking sector will grow really well, so I gave it a 3. Balance sheet strength, it's a 4. Governance and capital allocation, it's a 4 too. Macro risk, it's basically normal industry risk, so I give that a 3. So here it shows us how what's our score is some. So according to my valuation tool, it's a medium. And by this just and co- and using this these qualitative factors, it just adds or a decrease or decreases points, and it just shows me the new valuation. So our new valuation is 49.8, 24.97, and 28.47. Now we go to our bull, bear, and base case scenarios. So right now I put in growth as 24.6. My bear case growth net profit growth would be around 20, and my bull case net profit growth would be 30. Of course, you can change this depending on the business and like what do you think about it. But right now, I'm just putting this as it is. And of course, you can change the probabilities too. You can change that however you want. Like if you think that there, if you think that there's a really low probability of a bear case happening, so you can just change this to 10, and you can change this to let's say 55, and this to 30, and this will change the other valuation methods, the other valuation metrics. But right now I'm just gonna keep it 25, 50, 25. And then I of course did this to these ones too, and it automatically does the pricing, and it shows me the weighted fair value of the whole thing here. Here, of course, and then you can see here too. Here, as you can see here, bull case, your valuation would be 58, normal base case 47, and bear case 39. So right now, so we're not gonna take this. We're not gonna take operating profits. So, cause I told you the reasons before. So we're just gonna plot these ones, these points there. 47, 24, and 28. I think 23 and 26. Okay, 23 and 27. 23 and 27, of course. So these ones are again making these valuations stronger. Of course, the the growth rate is gonna be determined based off the business and its upcoming results. I personally think that after the business, after the stock reaches these, it will just go straight to this resistance, and after it breaks the resistance, it's just gonna go up, and it's gonna break these valuation and this whole thing too. Till then, I'll obviously exit because I'm not in this stock for a really long time. My usual my usual holding period is my median holding period is around like 2 to 5 years. So I'm just gonna get out of the stock as soon as possible after of course, after I make some decent money. So yeah, I think that's it basically. That's basically it from me. Again, thank you for watching this video. Please like, share, and subscribe to this channel. I really appreciate the support you're giving me. Thank you, and have a nice day.